Welcome to Section 6. We have walked through the full P2P cycle operationally and in the accounting records. Now we step back and look at the cycle through a risk and control lens. What are the real threats in this cycle? What controls prevent them? What detects them when they occur anyway? And what are the signals, the red flags, that tell you the cycle is breaking down before the damage becomes visible on the financial statements? By the end of this session, you will be able to distinguish preventive controls, which stop problems from happening, from detective controls, which identify problems after they occur. You will know the 8 risks in the P2P risk register, which are rated high versus medium, and what controls address each one. You will be able to recognize the red flags that appear in practice when the cycle is failing, and you will know which process improvements have the highest impact when a client needs to strengthen their controls. The P2P cycle requires 2 distinct types of controls, and neither one is sufficient on its own. Preventive controls are the gates. They stop unauthorized spend, unverified vendors, and unmatched invoices from proceeding. Detective controls are the searchlights. They find problems that slip through the gates. You need both. A business that has strong preventive controls but no detective controls will not discover when those preventive controls fail. A business that relies only on detective controls is accepting that problems will occur and hoping to catch them early. The goal is a layered control environment where each control reinforces the others, so that any single failure has a backup. 7 preventive controls anchor the P2P cycle. No purchase without an approved PR removes unauthorized spend at the source. PO approval thresholds calibrate authorization to risk. The approved vendor list ensures payments only go to verified suppliers. Dual authorization and phone verification for vendor master changes block payment redirection fraud. The mandatory 3-way match before payment prevents the cycle's most common financial errors. Dual authorization on payment runs ensures no single person can execute large cash transfers, and the self-approval prohibition on requisitions maintains the independence of every authorization in the chain. Remove any one of these and the cycle becomes vulnerable. 7 detective controls complete the framework. The duplicate payment check before every payment run catches the same invoice being paid twice. Weekly AP aging review surfaces invoices stuck in the system. Monthly supplier statement reconciliation is the external cross-check, the supplier's records compared to yours. The GRN versus invoice variance report finds quantity mismatches that slipped through. The monthly vendor master audit reviews every new or changed vendor entry for legitimacy. The Maverick spend report tracks invoices that arrived without a PO, and the payment run review actively looks for unusual patterns, round numbers, new vendors, amounts that do not fit prior patterns. Together, these controls detect what prevention misses. The P2P risk register identifies 8 risks across 2 levels. 5 are rated high. Unauthorized spend happens when the PR and PO requirements are bypassed. Someone buys first and raises the paperwork later, or not at all. Duplicate payments occur when the same invoice is entered twice without a prepayment duplicate check. Fictitious vendor fraud exploits weak vendor master controls. Someone creates a supplier that does not exist and routes payments to themselves. Payment redirection is the external version. An attacker gets vendor bank details changed before a payment run. Invoice fraud covers supplier impersonation and altered invoice details. All 5 carry high financial impact and require the strongest preventive controls. 3 risks are rated medium. Overpayment typically occurs when the 3-way match is skipped or overridden. The business pays an invoice that did not agree with the PO or GRN. The impact is cash overpaid and a recovery risk with the supplier. Late payment penalties arise when invoices are not processed through the cycle fast enough. AP backlog translates directly into additional cost and damaged supplier relationships. Understated AP and missing accruals happen when GRNs are raised, but no accrual is posted at period end. Expenses are understated, and profit is overstated. Medium rated does not mean low impact. It means these risks are somewhat more controllable through process discipline than through structural controls. Red flags are the observable symptoms that appear before a problem becomes visible in the financial statements. A high volume of invoices without POs means procurement discipline has broken down. Vendor master changes without documentation are a direct fraud signal. If you cannot see who changed a bank account and when, the vendor master has been breached. Frequent three-way match overrides mean the control is being bypassed by the people responsible for enforcing it. A growing unreconciled AP balance means invoices have been in the system for weeks or months without being matched, paid, or resolved. An ad hoc payment runs outside the normal cycle, especially to vendors recently added to the master, are one of the highest risk patterns in the entire cycle. Raise these with clients immediately. Do not wait for month end. 4 more red flags complete the picture. One person controlling both vendor setup and payment authorization is a segregation of duties failure that creates direct fraud risk. This combination must be identified and corrected immediately. Large period-end accruals without GRN support suggest accruals are being estimated rather than based on documented receipts. This is an accounting accuracy problem and an audit red flag. Supplier complaints about late or incorrect payments mean the AP process is visibly failing. Credit terms may be at risk, and the supplier relationship is being damaged. These are not hypothetical risks. They are the observable signs that a control framework has failed, and they need an immediate advisory response. When advising clients on strengthening P2P, not all improvements are equal. The 4 high-impact items address the highest-rated risks directly. Mandatory PO before any purchase eliminates maverick spend and unauthorized commitments at the source. Automated three-way match in the AP system replaces manual matching that is prone to override and error. Dual authorization with phone verification for vendor master changes blocks the most common fraud vectors. And a pre-run duplicate check before every payment run catches the most recoverable financial error in AP. In a small business with limited resources, these 4 improvements alone eliminate the majority of fraud and duplicate payment risk. Everything else is incremental. The P2P control framework requires both prevention and detection, and consistent enforcement of both. 5 high-rated risks drive the framework: unauthorized spend, duplicates, fictitious vendor fraud, payment redirection, and invoice fraud. Detective controls are only effective if they actually run weekly aging reviews, monthly vendor master audits, pre-run duplicate checks. Red flags appear before the financial damage becomes visible, so acting on them early is the advisor's highest value intervention. And when a client needs to strengthen controls with limited resources, 4 improvements cover the majority of the risk: mandatory PO, automated three-way match, vendor master dual authorization, and duplicate payment checks. In the final section, we apply all of this to real client advisory work. Thank you for completing this session on controls, risks, and red flags.